Okay, hi everyone. This is going to be the second lecture on chapter 8. So we're picking it up here with kind of FICA, self-employment tax. So just as a refresher, right, if you pay FICA, it's 15.3%. If you pay SE tax, it's 15.3%. Depending on, right, if you're an employee or an independent contractor, you're self-employed, that gets broken out differently. We looked at the setup of it for FICA, right? We said, hey, Jim there, he's going to be subject to it. He'd get a W-2. Now we're looking at self-employed, right? So self-employed individuals, they have to pay the entire 15.3%. They get an above the line deduction for 50% of that, and they will receive a 1099, okay? So we have Mr. Beast here. Essentially, right, a YouTuber, an Uber driver, somebody like that, they would be self-employed. They would have their income on their Schedule C, so it would be like their revenues minus their expenses from their business gets them kind of their net profit. They carry that over, right, multiply it by that 92.35%. Add together the liabilities over here. In other words, figure out, the different amounts on them. Hey, there's the self-employment tax. Half of that they get as an above the line deduction, right? So how do we do this in kind of an academic setup, right? Well, step one is going to be determine your net income from your self-employment. In other words, that's going to be this guy right here, this bottom number. So it will be your revenues minus your expenses. There you go. That's your net income from self-employment. Multiply that times 92.35%. Why are we doing that? Right? Well, hey, that's going to build in the 7.65% for the employer share, right? We got to keep things even Steven. Then you follow through, you figure out the Social Security portion. Be aware there's a cap on that. Figure out the Medicare portion. See, hey, is there an additional Medicare tax, right? Once you get above 200K, you could be subject to that. Essentially, what you then do is add them together, and that figures out your self-employment tax. So that's a lot of words. Let's look at an example here. We have an individual who has $18,000 of net self-employment income. So I don't know, say they had 20 grand of revenues and 2 grand of expenses on their Schedule C, lands up at 18. Multiply that by 92.35%, gives us 16,000. Figure out the Social Security portion, figure out the Medicare portion, add them together, right? The 2061 and the 482. Hey, our self-employment tax is going to be 2543. We're not subject to an additional Medicare tax because we're well below 200 grand. All right, so you can look at these other examples here, just to see if there's phase outs and whatnot. But that's the idea there with being self-employed. And again, we said there's special rules if you're an employee versus an independent contractor. It really comes down to, does the person paying have control over the person who's working, the time, the manner, and the location of the services, right? If they do, it's an employee. If they don't, it's an independent contractor, right? And again, why do we care about this? Well, for the corporation or the business as well as the employee, there's a different setup versus if they're an independent contractor, right? So if you're an employee, you pay half of FICA. You get health insurance. You can get a retirement plan with potential, matching contributions from the employer. You're going to have limited employee deductions, right? You're not filing a Schedule C, and your taxes will be withheld, right? Your income tax liability, your FICA tax liability. In distinction, if you're an independent contractor, you get hit with the entire 15.3%, though they do give you a 50% above the line deduction for that. You're not going to get health insurance. You'll have limited retirement plans. You can contribute, but there isn't going to really be a match on that. You do get business deductions, right? Those expenses on Schedule C. However, you have to make quarterly estimated payments. So what's the upshot of all of this? If you are an independent contractor, you likely should ask for more money, right? Because you're missing out on things like health insurance, retirement contributions, right? When you kind of look at the entire package, you need to get paid more if you're an independent contractor. All right, so we talked a little bit before about tax credits. We said that they reduce your tax liability versus tax deductions, which reduce your taxable income. Generally, credits are going to be more powerful than deductions, but it's a facts and circumstances determination. Now, when you're talking about credits, right, there's two types, non-refundable and refundable. The idea with non-refundable is, right, say that you owe $100 tax liability and you have a $175 credit, right? The idea with this is it can only take you down, this credit, to zero, right? That's the idea with it. It's non-refundable. It can't get you into refund land. In distinction, refundable credits, right? If we have the same setup, right, $100 tax liability and $175 credit, in this way, right, we can kind of break through that stop sign there and get us into refund land. Hey, we get a refund, they send us a check or a direct deposit for that additional amount, right? There isn't this kind of cap on it. So generally on the 1040, you're going to apply non-refundable credits first, then refundable. And when we're talking about credits, let's kind of see what are some of the common credits available, right? Well, the first one here is the child tax credit, right? Essentially, this is going to be $2,000 for each dependent child you have. The phase out here, right, you're getting pretty high, $400,000. So most people are going to qualify for this. In distinction, if you have other dependents, right, like a qualifying relative, you get a $500 credit for them. Next one here, child independent care credit. So the idea with this is going to help pay the cost if you have dependents at home while you're looking for work. Right, so say we have mom, right, she's going out to work, right, and she has son there who's at home. She has to pay for daycare, right? How does this work? So first off, you have to have the right type of kid. So let's just say, he's 10 years old. That's great. The rules here, they're going to have to be a dependent between 0 to 12, or it can be really anyone if they're physically or mentally disabled. So that's the first thing. You have to have the right setup. Somebody looking for work, and generally a kid below 12, like 12 and below. Next thing is you have to have the right type of expenditures, right? So normally these are going to be daycare costs. You can't kind of rig the system here by paying another dependent to babysit. So we're going to just keep it as, hey, you're paying daycare. The next thing too is you have to figure out what are the eligible expenditures, right? So the idea with this is you need to pick the smallest of these three guys, right? Basically, hey, what were the daycare costs? $3,000 if you got one kid, or $6,000 if you have two or more kids, and then your earned income, right? What's the smallest of these? That's going to be considered your eligible expenditures for purposes of the credit. So what you do is, hey, you take your eligible expenditures, right, the smallest of the three, times the percentage from the table, right? And this is basically looking at your AGI, and it goes from 35% down to 20%, right? There is kind of no cap on this, no limit. So let's look at an example here, 818, give it some numbers. All right, so it looks like we paid for daycare right? Let's just assume we have the right type of kid. Let's just assume that it's the right type of setup. We paid 10 grand for it, so that's the expense. Our AGI, let's just say, is 50,000, right? It's over 43. And then, we have the $3,000 limit. We have one kid, right? So step one here, we got to pick the smaller of those three things, right? The 10 grand for daycare, the 3,000 for the one child, or the 50 grand of income, right? Well, 3 is the smallest. There we go. We then would go down, use the table. Hey, let's just say our AGI is 50,000. We're over here, no limit. That's 20%. Multiply them together. Our dependent care credit in this case would be $600. Okay, so you can look at that. Nothing too hard, just a little bit of applied math. All right, next we're going to talk about some educational credits, right? So first one is the American Opportunity Credit. So this is essentially for the first 4 years of college that you pay for yourself, your spouse, or a dependent when they're enrolled half-time. Eligible expenditures, right? This is going to include things like tuition, fees, course materials. In the credit here, right, if you were to calculate it, right, like what's the actual amount of the credit? Well, for the first $2,000 of eligible expenditures, you get 100%. For the next 2,000, you get 25%. So you add those together, right? 2,000 plus 500. The max credit you can get for this is $2,500. And be aware that, hey, a taxpayer on a single return can receive multiple credits. And what I mean by this is, hey, maybe we have 3 kids. We pay for 3 of their colleges. We can get 3 of these credits. There's a phase out. Don't be too concerned with phase out numbers, but that's the idea with it. And let's look at an example here, 819, to give it some numbers. So let's just say we paid $2,000 in tuition and $300 in books, right? So we got $2,300 of expenses, and it's for the first year of college, right, for the daughter. Okay, so how do we figure out the tax credit? Well, hey, for the first 2,000 of this, we're going to get 100%. For the next 300, we'll get 25%. Add them together, there's our credit, $2,075. This is just saying, like, hey, if we make too much income, you don't get it. And then this is showing that, hey, it's 40% refundable down here, right? So down there, and then this guy is showing a partial phase out. Again, don't worry about the phase outs. I'd be more concerned, like on the exam, if I'm going to test credits, it's going to be more like, please tell me the credit before any phase outs or anything like that. All right, the next one here is the lifetime learning credit. So, right, this is for after those first 4 years, right? So, hey, maybe you go to grad school, you go to law school, or alternatively, right, you are later in life, right? The idea here is it's a credit to recognize expenses that help you to acquire or improve job skills. And essentially, it's going to be for very similar expenses. The books, it depends on if they're required for the course or not, right? But we'll keep it simple. We'll just say it's like, hey, your tuition, right? The credit here is going to be 20% up to $10,000 of expenses, right? So the max credit on the lifetime learning is $2,000. And in distinguish to the AOTC, right, to distinguish it, you only get 1 credit per return. Again, a phase out here. And then finally, be aware, hey, if you have a single expense, they're not going to let you double dip on it, right? You don't get, if you pay for college, $1,000, you get to use that $1,000 for the AOTC and the lifetime learning credit. You got to kind of pick it out there. So let's look at 820 here. So this is just saying, hey, we got a taxpayer. They pay $15.50 for a course to improve their job skills. Could you please tell me the lifetime learning credit? Oh, it's essentially 20% of those expenses, right? We're below that 10 grand threshold, $310. All right, here's a nice little summary. You can look at this to compare the two of them. Next one here is the earned income credit, right? The earned income tax credit. And essentially, this is to help low income individuals, right? It's trying to really encourage them to work. And one thing with it, right, it's a refundable credit. So really the idea with this is it's really meant to kind of be almost like a stimulus check, right? Because it's a refundable credit. It's going to get them into refund land. We're trying to encourage them to work. Now, there are criteria for it, and the amount of the credit you get depends on like your age, how many dependents you have. And like I said, there's kind of different steps here, and you got to use the table. So again, just follow the steps. If you see a homework question on this, it's not too bad. This as a calculation question doesn't really lend itself too well to the exam, right? Because that's kind of a messy credit. But as a homework, right, where you get potentially unlimited attempts, I think it's more fair to kind of play with the table and get to the end there. But again, it's just following steps. 1, 2, 3, nothing too hard. End of the day, what is it? It's a refundable credit. It's meant to help poor people, encourage them to work. If you ever were to participate in the VITA clinic and you volunteer for that, that's really a lot of times how we're helping those people get refunds through this earned income tax credit. Next one is just a little aside. This isn't in the book, but I have it just to kind of let you know that, hey, taxes do affect the real world. When there was COVID, right, they sent out these stimulus checks, right? And a lot of people just thought, hey, that's free money, right? And it's not free. Somebody pays for this. But really, what was it, right? So when we talk about tax credits, generally you're going to get them over here, right? Like 415 year 2, okay? The idea with an advanced credit, and sometimes you'll see this with like the child tax credit, potentially the earned income tax credit, right? Instead of giving me, I don't know, let's just say $2,000 over here, what they do is they push it out to you ahead of time, right? So maybe you'll get $500 ahead of time. And that's essentially like substance over form, what these checks were, right? If you got the $1,000 up here, it was essentially a credit, a recovery rebate credit that they pushed out ahead of time. So, and what they did was is like say, because they looked at your prior year tax return, say over here you only had, one kid, right? So what they did was maybe they gave you, I don't know, let's just say $2,000. However, at the time of this, right, they saw that you only had one kid. But let's say right here, you had a second kid, right? You were like, no, I should have got a payment for $3,000, right? Because like me, 1,000, like kid 1, 1,000, and kid 2, 1,000, right? So they paid me 2, but I should have gotten 3. That's where you get the difference, right? Through this recovery rebate credit. You basically get to recover anything they miss. Now, that's the idea with like how it happened. That was kind of a one-time thing. The stimulus checks, they aren't doing that every year. But it is an example kind of indirectly of an advanced tax credit where they push it out ahead of time. Now you can look at this, right? Businesses get credits, right? These are big deals, right? This R&D credit, it's a lot of times how big multinational corporations don't pay tax because there's a lot of incentivized credit for them. And then sort of a final credit here is the foreign tax credit. So the setup with this, right? When you have foreign income, right? Say here we are in the United States, and then here's Europe or something, right? Those are more like amoeba shapes than they are countries. But I don't know, let's say you make 100 grand here, and hey, you go over to Paris and you teach a class there, and you get 10 grand of income, right? There's 3 different ways in the US tax system you can get rid of that 10 grand, because as a starting point for the US, they want you to claim your worldwide income. So you got to put 110 in theory on your tax return. But they give you 3 mechanisms to help alleviate double taxation, right? The first one is an exclusion, right? You can exclude up to like something like 100 grand, 110 grand. It's inflation adjusted. You can take an itemized deduction for foreign taxes paid, this FTP, or you can get a foreign tax credit, right? So that's what we're looking at here, a foreign tax credit. Essentially with this, you can help offset and relieve double taxation. So essentially how this works is, let's say this 10 grand, right? If you had 10 grand of income, let's just say in the US, right? Let me back this out. Let's say this 10 grand of 10 grand of income over here on your US tax return, let's just say it created a 3K tax liability. But in France, right, because you got to claim it in France and they have a higher tax system there, let's say you paid $5,000. The idea with this is you can carry over, use these foreign taxes paid as a foreign tax credit, but you can only offset up to your US tax liability. In other words, that excess, that $2,000, hey, I paid France 5, but you're only giving me a credit for 3, you don't get the difference there, right? That's the idea. It's up to the tax liability that would have been generated on the US return. So it makes you a little bit more even, but not fully even. So 2 countries are kind of taxing it. So you got to see, are we in a higher tax country overseas or a lower tax country? But that's the idea with it. How you calculate it, right? It's going to be your foreign income over your worldwide income times your US tax liability before the foreign tax credit. So this guy, right, you can just peruse through this, right? Don't spend too much time on this because there's other sort of nuanced credits in there. Just look it over. This says, hey, generally we're going to apply non-refundable credits first and then refundable credits afterwards. And on the back end, right, we're talking about prepayments and estimated payments. Okay, so normally, if you're W-2, right, you're going to have your income tax, what you owe throughout the year, withheld through your job. If you're self-employed, however, you're going to have to make estimated payments, right? Nobody's withholding. So as a general rule, right, the IRS doesn't say like, oh, okay, here's the end of the year. You can just, pay us then, right, what you owe us. No, they need that money throughout the year to run the government, right, to run the country. So if you're an employee, hey, your employer's withholding it and sending it in. But if you're self-employed, nobody's withholding it, right? You have to affirmatively recognize that you have to send in these estimated payments. But the question becomes, right, like, so say I'm self-employed, how much do I know to put into the system? I don't know how much I'm going to make this year, right? Well, what then happens is, right, if you don't put enough into the system throughout the year, right, like maybe I needed to put 100 in, but I only put 30 in, right? I just didn't make these estimated payments. I didn't know, right? What happens here is, one, not only do you owe what you owe, right? So say that you had to put, I don't know, 100 in, right? That was your tax for the year. But say you only put 30 in. right? That difference, you're going to owe that difference, the 70 grand, plus we're going to put a penalty on top of that, right? It's going to be an underpayment penalty. You didn't put enough in. So that's the idea of high level, right? You got to be aware, yeah, I got to put stuff into the system throughout the year. If I don't put enough in, I'm going to not only owe the difference, but they can also hit me with a penalty. However, right, one way you can avoid this penalty, right, is if you get or meet one of these safe harbor rules. In other words, hey, this is a safe harbor for you. If you put X into the system, right, we're not going to hit you with this penalty. You'll still owe the marginal amount you owe, right, but at least we're not going to hit you with this penalty. In the standard here, there's two safe harbors, right? If you put into the system 90% of your current year tax liability, we're not going to hit you with the penalty. Alternatively, right, say that you're like, I don't know what 90% of my current year tax liability is. This is my first year of operations. Or alternatively, my income ebbs and flows, right? Or I just don't know, right? So one of the things you can do is, right, if the current year is sort of a mystery, right, like I don't know what I'm going to make this year, what my income tax liability is going to be, you can phone a friend to the prior year, right? And what this says, if during the current year you put into the system 100% of your last year's tax liability, then you aren't going to owe the underpayment penalty. Now, if last year your AGI was greater than 150 grand, it's going to be 110%, but that's the setup on it. Okay, so here's the high level summary. The IRS doesn't say wait until the end of the year to put or pay your taxes, right? We want the money throughout. So if you're an employee, hey, you're going to have your employer put it in. If you're self-employed, you need to send in quarterly estimated payments. And we said, right, if you don't put enough into the system, so let's say that Mr. Beast, right, he's self-employed, he owes 100, okay, but he put 60 in, right, he made 4 payments of 15 grand, he just kind of guessed. Well, the idea here is not only is he going to owe the 40 grand, right, the difference between what he owes, but they're also going to hit him with a penalty, right, this Mr. Yucko on top of it. However, right, we can avoid the penalty. We can get rid of Mr. Yucko if we meet one of these safe harbor tests, right? And the idea with this is if during the year you put 90% of the current year tax liability in there in the system, hey, you're not going to owe a penalty. Alternatively, if you're not sure what your current year tax liability is going to be, you can phone a friend to the prior tax year, right? And if during the current year you put 100% of prior year tax liability in there, then we're not going to hit you with a penalty. So one thing to be aware of, this is a simplified method. This is looked at it at the yearly amount. When they actually charge this penalty, right, the penalty, they do that quarterly, but I'm just explaining it to you high level so you understand what's going on. So let's look at the two safe harbors, right? The first safe harbor, if you put 90% into the system during the year of your current year tax liability, you get rid of Mr. Yucko, right? You don't get hit with the penalty. So with this, right, say we had an individual who has 100K of year 2 income, right? The idea with this is they must put 90% of that into the system by year end, right? So in other words, they must have 22.5, 45, 67, and 90 by the end. And remember, they do it quarterly. So what you can do here, right, to figure out what your estimated payments were is you could just say, okay, I'm using the 90% of current year. I'll take my tax liability times 22.5%. I better have that amount in by the end of the first quarter. By the end of the second quarter, I take my tax liability, I multiply it by 45%. It's essentially, if you're wondering why is it 22.5, 45, 67, it's essentially in those cases, right, 25, 50, 75, 100. But if you were to multiply it times 90%, that's where you get those amounts. But do be aware, right, know those. Now, let's look at the second safe harbor. Right, let's say we're in year 2 again, right? And let's say that we want to use the prior year, right? So what we do is we phone a friend year 1 and we say, hey, what was our tax liability in that year, right? 80K, right? Let's just say that. So now what we have to do, and again, because it's 100%, we can use 25, 50, 75, 100. We have to have into the system by the end of the year that 80,000. But again, you just don't pay it, 80 at the end of the year. You have to, under the standards, have 20, 40, 60, 80 in respectively by the end of each quarter, namely 25%, 50%, 75%, or 100% of that prior year tax liability. So this just says that, hey, you could be asked to make estimated payments in practice if you meet both safe harbors, right? It's like you meet 90% of current year, you meet 100% of the prior year. Which one should you pick? Well, whatever one gives you the lower payment, right? Because you can use that excess amount to invest in the stock market. The last guy here, this just gives some numbers to the different penalties, right? So we have an underpayment penalty, a late filing penalty, a late payment penalty. How do you actually calculate these? So again, just be aware of them. I'm not too concerned with these minutia calculations here. Normally in practice, what happens with these is that the software does it automatically. But let's just look at a couple more examples and we'll button this one up. Okay, here's the earned income tax credit if you want to look at that for the hallmark. Here's just showing an ordering rule of, hey, you take non-refundable credits first and then generally refundable credits. This one is saying, hey, if we have an estimated tax liability for the current year of $6,100, then, it's not. If we have an estimated tax liability of $24,000, right, what we need to do there is put into the system estimated payments, right? So this is just a high level showing if we have a tax liability, how you would divide that. Then, right, how do you actually figure out, what do you put in? You have to compare it, hey, what you put in versus what was withheld or required to be withheld. Are you over withheld or under withheld? Okay. And then this guy right here is basically showing how do we calculate that underpayment penalty. And these two are just calculating those late filing penalties and the other sort of penalties associated with the underpayment penalty. So again, it's nothing like too hard. It's just kind of you have to look at it bit by bit. So with that, kind of review the materials, look at the homework, and we'll see you in the next lecture.